I've talked on this channel about having a more defensive portfolio, holding far less in equities than most investors. But there's an obvious question. Does it actually work, or am I just making things more complicated to produce lower returns? If markets crash, does this portfolio really protect me? If markets keep rising, am I going to get left behind? So in this video, I'm going to stress test my whole portfolio against two very different scenarios. A global stock market crash of 40% and a bull market where global equities rise another 25% over the next year. And by the end, we'll see whether my defensive approach makes sense or whether I'm just being too cautious. So let's start with the nightmare scenario. Global equities fall 40% over the next 12 months. Not a small correction, not a wobble, a proper bear market. A sort of environment where headlines become increasingly negative, investors panic, and many portfolios suffer significant losses. If that happened, my modelling suggests my portfolio could actually return around 5%. Now, that won't be exact, no forecast ever is, but after looking at how each asset class has behaved historically and making what I think are reasonable assumptions, that's the number I've arrived at. And in a moment, I'll show you exactly how I got there. But what if I'm completely wrong? What if valuations stay elevated, artificial intelligence continues to drive earnings growth, and investors remain willing to pay ever higher prices for equities? In that world, global stock markets could rise another 25% over the next year. Surely that's where my defensive portfolio gets left behind. Well, according to my modelling, the portfolio would still generate a positive return of around 4%. That's obviously much lower than the stock market itself, but it raises an interesting question. How can a portfolio with very little equity exposure potentially make money in both scenarios? To answer that, let's start with the asset allocation. Around 40% of my portfolio is in cash and very short duration gilts. 32% is in short duration inflation-linked bonds. Around 24% is in a range of defensive and absolute return strategies, and 4% is in gold. This portfolio looks quite different from many portfolios investors hold today. The reason is valuation. This chart shows the relationship between starting valuations and the returns investors have subsequently received over the following decade. With the S&P's current cyclically adjusted price-to-earnings ratio, history tells us that expected returns over the next 10 years will be roughly 1% per year. That might not happen, this time may be different, but that's what the data points to. If we look at a different valuation measure, the FTSE US forward price-to-earnings, and compare it with subsequent 10-year returns, current valuations have historically been associated with annual returns of less than 1% per year over the following decade. That doesn't mean markets can't continue rising from here, they absolutely can, but it does suggest that investors are paying a very high price for future growth. And that's one of the reasons I've chosen to build a more defensive portfolio. Let's begin with the bear market scenario. Assume global equities fall by 40% over the next 12 months. The question is, what happens to a portfolio with very little equity exposure? Let's start with the largest holding, cash and short duration investments. In a world where equities fall 40%, I would expect this part of the portfolio to return roughly 3.75%, which is broadly in line with the current Bank of England interest rate. This is the strength of cash. While other assets are falling, cash continues earning income and the range of outcomes is relatively narrow. Returns could vary depending on movements in interest rates, but probably not by much. At the portfolio level, that translates to roughly 1.5 percentage points of return. So before we've even looked at the other assets, the cash allocation is already doing a meaningful amount of the heavy lifting during a downturn. Next are inflation-linked bonds, which make up around 32% of the portfolio. In this scenario, I'm assuming a return of around 5.5%. That might surprise some people because bonds aren't usually thought of as exciting investments. But in a severe market downturn, central banks often respond by cutting interest rates, and falling real yields can provide a tailwind for inflation-linked bonds. On top of that, investors continue to receive inflation adjustments and income throughout the year. Of course, there is uncertainty here. If real yields rise unexpectedly, returns could be lower, which is why I've used a fairly wide range of outcomes from 0 to 8.5%. Even so, my expected contribution to the portfolio is around 1.7 percentage points. At this stage, cash and inflation-linked bonds alone are contributing over 3 percentage points of return in the bear market scenario. The third bucket is what I call my defensive and absolute return allocation. This includes hedge funds, long-short equity funds, and wealth preservation funds. In a severe bear market, I would expect this part of the portfolio to return around 6%. That's based on the historical performance of these investments during previous bear markets. There is more uncertainty here than with cash or inflation-linked bonds, which is why I've assumed a wider range of outcomes from a loss of 4% to a gain of 12%. But even with that uncertainty, the expected contribution to the overall portfolio is around 1.5 percentage points. The final bucket is gold, which makes up around 4% of the portfolio. In this bear market scenario, I've assumed gold returns around 10%. That's because gold has often performed well during periods of financial stress, especially when investors are worried about markets, currency, central banks, or the wider economic system. But gold is also volatile. It can fall sharply even when the long-term case for holding it is strong. So I've used a wide range here from a 15% loss to a 25% gain. But because gold is only 4% of the portfolio, even a strong return doesn't transform the overall result. But it still adds around 0.4 percentage points to the portfolio. And now we can put the whole bear market scenario together. Putting all that together, my expected return in this bear market scenario is around 5.1%. In other words, if global equities fell 40% over the next 12 months, I would expect the portfolio to broadly preserve capital and potentially generate a modest positive return. Of course, stress testing is not prediction. The future will not follow my spreadsheet. That's why I've shown ranges rather than precise numbers. In a particularly unfavourable outcome, the portfolio could be roughly flat or slightly negative. In a more favourable outcome, returns could be significantly higher. But the key point is this. The portfolio has been constructed so that even if markets fall, the portfolio should produce positive returns. Now let's look at the opposite scenario and see what happens if global equities rise by 25% instead. Let's start with cash and short duration investments. The assumptions here are virtually unchanged. If equities rise strongly, cash still behaves like cash. I would expect a return of around 3.75% with a relatively narrow range of outcomes. For inflation-linked bonds, the picture is slightly different. In a strong equity market, I would expect a more modest return of 3.2%. That's because real yields may remain elevated or even rise, limiting the capital gains we saw in the bear market scenario. Even so, the combination of inflation adjustments and income should still produce a positive return, contributing around 1 percentage point to the portfolio overall. The defensive and absolute return allocation should also continue to generate positive returns. These funds aren't designed solely for bear markets. Many aim to compound capital across a range of market environments. I've assumed a return of around 5.2%. As before, there is a fairly wide range of possible outcomes depending on the strategies involved. And finally, gold. Gold is probably the most difficult asset to forecast in a strong equity market. Sometimes it rises alongside equities, sometimes it falls. So I've assumed a return of roughly 0 with a very wide range of possible outcomes. Putting all that together, my expected return in this bull market scenario is around 3.8%. That's obviously well below the 25% return generated by global equities. But that's exactly what you would expect from a defensive portfolio. The goal isn't to beat equities in a roaring bull market. The goal is to produce acceptable returns while taking significantly less risk. And according to this stress test, that's exactly what the portfolio appears to do. So the question becomes, is giving up some upside during the good times worth it for the protection offered during the bad times? For me, investing isn't about maximizing returns. It's about balancing risk and reward, weighing up probabilities. Every investment decision involves a trade-off. The possibility of higher returns usually comes with the possibility of larger losses, and the possibility of avoiding large losses often means accepting lower returns. The challenge is finding a balance you can live with. This is roughly where we think different assets sit on the risk-reward spectrum. Cash is generally lower risk with lower returns. Bonds typically offer slightly higher returns and slightly higher risk. Equities have historically delivered strong long-term returns, but with greater volatility. And assets like crypto sit further out, with the potential for both large gains and large losses. Of course, these positions aren't fixed because assets can become disconnected from where we'd normally expect them to sit. And this is where opportunities and dangers arise. Today, I'm not convinced the opportunities are particularly attractive in equity markets. When I look at current valuations, I see an asset class that still carries all the normal risks of equities. Recessions can happen, earnings can disappoint, sentiment can change, markets can fall 30, 40% or even more. But despite taking those risks, the long-term returns implied by current valuations appear relatively low. That's the disconnect I struggle with. To my eyes, the risk looks high, while the prospective reward looks fairly modest. And that's why I've chosen to position the portfolio more defensively. Not because I know what will happen next, but because I don't think the current balance between risk and reward is especially attractive. Now, maybe I'm right, maybe I'm wrong. A year from now, global equities might be much higher than they are today, or they might be much lower. I don't know. What I do know is that investing isn't just about chasing returns, it's about managing risk. And at current valuations, I'd rather focus on preserving capital than stretching for an extra few percentage points of return. Warren Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, of course, every investment carries risk, and losses are sometimes unavoidable, but the principle is sound. If you can avoid the big losses, you don't need spectacular gains to make progress over time. And that's the thinking behind the portfolio I've built today. Thanks for watching, and I'll see you at the next video.